In the near future, the American stock market is set to absorb a massive shock. Up to $4 trillion in new stock market value is about to be listed all at once. Three specific tech titans are driving this listing wave. OpenAI and Anthropic are leading the charge on artificial intelligence, while the largest piece of the puzzle is the aerospace giant, SpaceX. When these companies go public, the natural instinct for anyone with a brokerage account is to try and buy a piece of the commercial spaceflight and AI booms. But stock markets operate on a rigid friction. The absolute best moment for someone to sell a share of stock is almost never the best moment for you to buy it. So if these three companies are practically guaranteed to run the future economy, we have to ask, why are there early investors in such a huge rush to sell their shares to you right now? To understand why, you have to look at how an initial public offering actually works. Companies generally sell stock to the public for three mechanical reasons. They need to raise billions in operating capital to build things, their employees want to turn their equity into cash, and their early private investors want to lock in their profits. Right now, everyday investors are incredibly eager to buy into AI and space technology, pushing tech stock prices consistently upward. That creates a perfect environment for early insiders looking to cash out. The investment bankers pricing these massive listings are hired by the companies going public. Their job is to optimize for the highest possible payout for the sellers, with zero obligation to leave room for the buyer to make money later. When the people with the deepest inside knowledge of a company suddenly decide they'd rather have cash than their own shares, it strongly suggests they think the overall stock market is nearing its absolute peak. Modern tech companies stay private far longer. If SpaceX lists, it seeks a massive $1.75 trillion valuation, asking investors to pay 90 times its annual sales. The explosive early-stage wealth generation has already been extracted. To justify buying in at a multiple that high, you must assume they will execute near-impossible technological feats, like launching data centers into orbit or successfully monetizing trips to Mars. You are effectively being asked to pay absolute top dollar for immense corporate growth that has already happened behind closed doors. The academic data on these kinds of listings backs up that caution. Finance researcher Jay Ritter at the University of Florida has compiled a massive dataset tracking post-IPO stock returns going all the way back to 1975. A clear pattern emerges on this graph. In their first 3 years, newly listed firms consistently underperform, sinking well below the steady baseline of the S&P 500. They lack the broader market by an average of 20 percentage points. The data also shows a strict caveat. For companies that list with extremely high price-to-sales ratios, which SpaceX certainly has, that historical underperformance is actually much more severe. Buying shares of a highly hyped mega listing on the very first day of public trading is a historically reliable way to lose money. Even if you look at the math and decide not to buy these individual stocks, there is a good chance your retirement fund is going to buy them for you. A massive proportion of modern retirement savings sits in passive funds that track indices like the S&P 500, and index providers are now actively fast-tracking these huge new companies into their indices, sometimes just 5 days after they first list. Fast-tracking forces trillions in passive capital to automatically purchase these highly volatile new shares. But once that mechanical forced index buying is exhausted, the natural buyers dry up, and the share price plummets. The rigid mechanics of passive investing take the everyday retirement savings of millions and turn them into guaranteed exit liquidity for early venture capitalists. To fully grasp the threat, we have to step back and look at the wider market. For the better part of a decade, the broader stock market has been heavily supported by massive tech companies actively giving excess cash back to their investors. Under that old system, major software and internet firms operated with very low capital costs. They threw off enormous amounts of cash and used it to buy back their own stock, which continually pushed market prices higher. But building thousands of commercial rockets and training huge artificial intelligence models requires unimaginable amounts of physical infrastructure. The heavy costs of the AI and space era are violently reversing that flow of cash. Instead of returning money to the market, these next-generation tech titans are aggressively extracting it. They are sucking up capital through these massive initial public offerings, huge corporate bond issuances, and follow-on share sales. Every dollar used to buy these highly priced new shares is a dollar that cannot be used to buy existing stocks. the market is left with significantly less free-floating cash to prop up broader share prices. The injection of $4 trillion in new stock listings is a massive, systemic drain on capital. It strips the exact financial support that has kept asset prices high for years, and it holds the potential to drag America's historic bull market completely down with it.